Hi, Sebastian here from Wealth Depot, and thank you for joining us tonight for our special SMSF Self Managed Super Fund presentation. We have a very special guest with us, Mr. Daniel Butler from DBA Lawyers, who's going to run through the majority of the presentation and provide insights around contribution, pensions, estate planning, and those all important things, binding death benefit nominations. We're going to touch on limited recourse buying arrangements with related parties, and we're going to touch on valuations and trustee obligations regarding investment strategies. So definitely a lot of content to cover tonight. I thank Daniel for his time. I thank you for joining in and hopefully taking something away from this presentation. Your questions will be answered throughout the presentation. Don't be shy to throw us anything that's on your mind. As always, the slides and the recording will be available after the presentation. As always, it's important that we ensure that you're aware of our general advice warning, that any material discussed tonight is general in nature and does not take into account your personal objectives or needs. So without further ado, I'll bring in Daniel Butler.
The topics that I have to present to tonight is managing pensions, just some tips and traps. We'll look at contributions especially leading up to 30 June next year. We'll touch on estate planning. We'll look at some real basic points about estate planning, like individual versus corporate trustee. We'll just touch on that. We'll look at a couple of examples on binding death benefit nominations. We'll look at testamentary trust wills. We'll look at a few other items. And yeah, as Sebastian said, we're here to answer your questions tonight. So if you do have questions, please put your hand up and we would be pleased to answer your questions.
Just a quick one before you get straight into it. Got just a very general question. Obviously, superannuation is a big part of our of the Australian way of life. I mean, it's nearly everyone's got a super account these days. But just for the average punter, what is super and what is it there for?
Good question, because really super is providing for your retirement and future. It also is a tax-driven vehicle. Like when I say tax-driven, who would want to put money into super because of all of its restrictions and special rules, and you have to have it audited without getting some upside? So the upside to super, one would hope, would be tax benefits. So if there are material tax benefits, we are inclined to say, and we've got the money, take advantage of super. And therefore we can get some significant tax breaks on putting money into super. So we start building up our super. For instance, if you're an employee, your employer could be putting in the super guarantee contribution every salary package that you do, or every quarter. It might be 9.5%, but on top of that, you could actually top your super up and still get a tax deduction for it under certain circumstances. So very good point, Sebastian. Super really has to be proven to be good for you, but super as well can be a good vehicle for insurance. So you may not have a lot of super, but you need insurance. And I'm sure speaking with Sebastian on that front and your advisors would be a good thing to do to make sure you are covered.
Okay, thank you very much.
Moving on to pensions. With pensions can be very tax effective. Here's where, when you attain the right age, you can pull money out of your super every year progressively. It starts off, as we see here, under 65, there's a 4% withdrawal rate. So if you're fortunate enough, and I used $1 million of the account balance. So let's say Mary has $1 million in her account. She could withdraw a minimum of 4%, being 40,000. However, the government has halved that rate for this financial year. So it's only 2% that is required to be withdrawn by Mary for this financial year if she's under 65. So in this financial year, it's only 20,000, and that's to take into account the effects of COVID. People's investments may not be performing as well. Cash flow might be tight within that fund. So the government has halved the minimum drawdown for this financial year, and that also applied for last financial year. You will also note from this chart the different age levels, that percentage factor goes up. And it eventually gets, once you get over 94, it is 14% of your money. So if you were over 95, for instance, and it was a normal year, you'd need to pull out on a $1 million balance, you need to pull out $140,000. However, this year it's halved and that's only $70,000 minimum. So that applies to both account-based pensions and to what are referred to as transition to retirement income streams, or otherwise known as TRISs. As mentioned, the pension income flow for this financial year and last financial year was halved. That's due to COVID. The COVID effect, like if you have property, you may not be getting the full rent. So the government took this into account in halving the pension minimum rate. The real question for a lot of self-managed funds in particular this year may be, can you actually fund the minimum? So in the example before of $1 million, you're under 65, do you have enough money cash flow wise in your fund to pay out that $20,000? Would your fund, for instance, need to sell some shares, sell some assets? It may be difficult if your fund is wholly into, say, a real estate property, which is a large proportion of your fund. It may be hard to get the liquid funds to do that. It therefore may be necessary for you to make contributions to the fund, because contributing to the fund would give it cash flow, which can then pay the pension. So what I'm recommending is, for this year in particular, undertake cash flow analysis, sit down, do your analysis. What cash have you got in there? What contributions will be made? What is your minimum pension? If you are already paying a pension and that pension is a regular, say, monthly payment or a quarterly payment, you don't, in a self-managed fund, you don't need to pay on a regular basis. You could leave that to the end of the year. You could see what is the cash looking like towards 30 June and then pay out your annual pension minimum. However, be very careful not to overlook paying the minimum. If you don't pay the minimum, there are consequences. Indeed, if you find that for one reason or another you cannot pay the minimum, it may pay you to actually stop, or what they refer to as commute the pension. So think about your cash flow. Think about, have you got enough money in the fund to pay your pension and your spouse's pension if your spouse or partner has a pension, and do some cash flow analysis. As mentioned, failure to pay the minimum has consequences. The ATO view, as expressed in this ruling, tax ruling 2013/5, the ATO have said, if you fail to pay the minimum pension prior to 30th June in a financial year, the pension just comes to an end. The pension ceases, and the ATO view is it ceased as of the start of that financial year. So if you get towards May, the end of May 2021, and if you have not got the amount required to pay the minimum pension, and if you overlook paying the minimum pension by 30th of June, then the ATO view is your pension has stopped, and that pension has stopped from 1 July 2020. It's quite a harsh rule. So be very careful. There are some concessions. You can go to the ATO to say, look, I overlooked my minimum, but they're very strict requirements to get through a concession. So its best position is to pay the minimum. If you do not pay the minimum, any withdrawal will be treated as a lump sum. And that lump sum could have consequences if you are paying a TRIS, because with a TRIS, if you haven't satisfied a condition of release, such as retirement after your preservation age, which is generally 57 these days, then that may be treated as a lump sum that is taxable at higher tax rates. So be very careful about making sure you are paying the minimum, and if you don't pay the minimum, your pension ceases, and be careful, therefore, of making any further withdrawals at that point.
Sorry, Daniel. Maybe just ask a quick question. So when you're paying pensions, is it only in the form of cash, or can pensions be paid in other forms?
Very good question, Sebastian. I've had clients come to me to say, look, Dan, we're out of cash. Can we transfer some shares? Can we just do a transfer of that share certificate? And the ATO do not accept that. The only instance that they will accept a payment of a pension is when you commute. So if you commute, that is stop your pension, provided you're funded the minimum amount by way of cash, any amount that you commute, you could then pull out by way of by way of in kind, such as property or an asset. But that is only the amount above the minimum. So very good question.
Fair enough. Thank you.
In respect of a lump sum, you can pull out a lump sum in kind. Like some people may prefer that they do want to get some assets out of the fund. They don't want to sell their shares or their real estate, and they have the real estate there sitting until they retire. And when they retire, they could have that real estate transferred out to them as their lump sum benefit. Now, the other thing that was introduced in mid-2017 was this concept of a transfer balance account. The transfer balance account is to measure your $1.6 million transfer balance cap. So the transfer balance cap is when you commence a pension, the maximum you can actually allocate towards the commencement of that pension is $1.6 million. So therefore, when you start a pension, let's say you start a pension for $1 million, you get a credit of $1 million to your transfer balance account, which then brings your remaining cap to 600,000 because you've started with 1.6, you've used up 1 million, therefore you have a balance of $600,000. So just be very careful, because the point that I make about your transfer balance account is if you're not able to fund your minimum, and if it's taken that your pension has ceased, you then have to readjust your transfer balance account because it has a credit, and when you stop, you then want your debit to reduce the credit. And all of that just gives rise to extra paperwork, extra costs. And let's say you then wanted to restart a fresh pension, you then have to go through the process of starting a new pension. That is typically getting advice. It's best that you seek advice from your accountant and financial planner, get the right documents, and then start your pension afresh. And then notify the ATO of that fresh pension by way of a credit to your transfer balance account. So you can see what I'm saying. If you do have a pension, don't jeopardize a pension by not paying the minimum. If you realize you cannot pay the minimum by 30th of June, then take advice and maybe stop your pension earlier so you can actually minimize any downward consequences. Because if your pension ceases, you lose the pension exemption. And as mentioned before, the ATO view is that you lose your pension exemption from the prior 1 July. Conversely, if you want to pull out more than the minimum pension, and going back to what we said before, Mary with $1 million, she is below 65 years. Her minimum this year is $20,000. So Mary could pull out $20,000, but she could pull out, being an account-based pension, she can pull out effectively the whole lot. Mary, being an account-based pension, could pull out $1 million. But let's say Mary needs to do some renovations. She wants to go for a holiday interstate. Don't come to Victoria, Mary. Stay outside of Victoria at the moment. You'll get locked up. Sorry, just a little joke from a Victorian. So if you wanted to pull out, say, 100,000 and your minimum is 20,000, Mary would be well advised to consider pulling out the $80,000 by way of a lump sum. And in that event, Mary could pull out $20,000 in cash and $80,000 by way of, say, shares or other assets in the fund. And she would want to do that, pulling out the $80,000 above the minimum by way of a lump sum rather than a pension, because in that way, by pulling out a lump sum, she can get a debit off her transfer balance account. So that's how you keep your maximum transfer balance account going. If you're pulling it more than the minimum, generally we access that as lump sum, but again, you need some special paperwork to maintain the maximum concession in the future to put more money into a pension account balance, which is tax-free within that fund. Moving on from pensions, we're now looking at contributions because, as mentioned before, a contribution is important. We may be entitled to tax concessions. Indeed, a concessional contribution cap, the general contribution cap for this financial year is $25,000 per member. It doesn't matter what age you are. You've got to be a bit careful if you're under 18. You've generally got to be employed or in a business under 18 to get that deduction. But the really interesting thing here is your contribution cap in which you may be able to claim a tax deduction may be much higher than $25,000. We have this rule that came in from mid-2018. So from mid-2018, if you have an unused cap, for instance, in this example, I have Roland. Roland's employer has contributed $10,000 per annum over a 3-year period. That is in financial year 2019. 2020, Roland's employer has only contributed $10,000 per annum in those 2 financial years. So Roland has an unused contribution cap of $15,000, being the $25,000 minus the $10,000 for each of financial year 19 and 20. So he's got a bring forward of effectively $30,000 of unused concessional contribution cap. That can be added to this year's cap of 25. So Roland is looking at a potential cap here of 55,000. So let's say Roland's got a bumper year and he's got, say, well over 150,000 of income. Roland can do a contribution of 55,000 and write off 55,000 against his 150,000 taxable income to bring his taxable income down to 95,000. Now, the key criterion for Roland is that his balance is less than 500,000 at the start of that income year. So provided Roland has less than $500,000 in super, in every super fund account, you have to bring together and look at that based on the market value at the prior 30th of June, if less than 5,000, and if Roland from 1 July 2018 hasn't taken advantage of his full concessional cap of 25,000, the unused amount can be used for a rolling 5-year period. So this is a very good rule. Some people may not be aware of it. Even a person who's a child starting in the workforce may have a bring forward unused contribution cap, which could prove very useful if you have, say, a business and you are employing your children. It could be quite advantageous, or it might be just family trust distributions. A passive family trust distribution or a dividend distribution via a family trust to someone with an unused contribution cap could be quite tax effective. We will move on now to non-concessional contributions, which I'll refer to as an NCC. Here, the cap is 100,000 per annum per financial year. So typically the non-concessional cap is 100,000 per annum. However, where the member has a total super balance, the total super balance is the opening account for that financial year of below $1.6 million, it may be possible for that person to make a $300,000 contribution by way of a non-concessional contribution. So this transfer balance cap of 1.6 and the total super balance cap of $1.6 million were introduced with effect from mid 2017. And that was a very major reform. And that was to really curtail some of the advantages to superannuation. However, if you have less than $1.6 million, you may be entitled, if you are 65 or less, to make a $300,000 contribution, being an after-tax contribution. It is interesting because quite recently, from 1 July 2020, the age cap has increased from 65 to 67. So previously, if you were over 65, you had to satisfy this work test. But now it's only when you're over 66. So when you're over 66, you now have to satisfy the work test. So when you effectively 67, you have this work test that you generally have to satisfy to make a non-concessional contribution or a spouse contribution. Now, let me explain the work test. The work test is, if I was 67, I would need to work for 40 hours in 30 consecutive days before I can make that contribution. So I've got to get the 40-30 test under my belt. Now, some people used to wait until 1st of July before they made that contribution. So if you're over 67 and you wanted to make a non-concessional contribution, say on 1 July 2021, I would advise you to at least wait for a couple of days, because then you could at least have 40 hours of work within at least 2 or 3 days if you're working long hours. But look, typically you wouldn't want to make a contribution until, say, later that month or 1 August next year in a fresh financial year, so that when you're over 67, you have satisfied that 40 hours in 30 consecutive days. So this is quite a recent change. So those under 67 no longer have to worry about that gainful employment test. Indeed, someone aged between 67 to 74 must satisfy that test. However, there is an exception. This is trouble for our super rules. It's layer upon layer of rules. The exception when you are over 67, if your total super balance is below $300,000, you do not have to be gainfully employed, provided you were gainfully employed in the prior year. So there's this special exception for those below $300,000 in super. You can make a contribution and rely upon gainful employment in that prior financial year. Now, I did mention before the capacity to make a contribution of up to $300,000. We call that, as mentioned on the last bullet point on this slide, that is called the bring forward rule. Under the bring forward rule, you can bring forward up to a maximum of 2 years of non-concessional contributions. So the 2 years of non-concessional contributions plus the current year of 100,000 brings us up to a total potential of 300,000 by way of non-concessional contributions. Now, it is interesting that even though the work test is now set at over 66, the bring forward rule is also proposed to be varied, but the legislation is currently stuck in Parliament. So the age limit remains at 65 until hopefully later this year or early next year, when we do see the legislation pass to make the availability for the bring forward rule to apply to someone who is under 67 years of age. Just to explain that by way of diagram, I have a diagram here which goes through, here's Mary. Mary turns 66 during this financial year. So Mary's going to turn 66, but she was 65 during FY 220. Given that scenario, because the bring forward rule was when Mary was under 66 during 2020, she could have made a $300,000 contribution during financial year 2020. That was before 30th June 2020. Under the proposed rules, when they change, when we do have the legislation that passes to say that the bring forward rule will apply for someone at age 66 as well, Mary could have made further contributions such as 100,000 at 65, 100,000 at 66, and provided she was still under 67 at any time during that relevant financial year, then she could have made the $300,000. So she could have easily made more money into super, put more money into super, had she could take advantage of that proposed change to the bring forward rule. That's assuming Mary is not gainfully employed after that age. But if Mary's gainfully employed after 67, she can still consider putting in $100,000 per annum. But in that event, the real question is whether that bring forward of 300,000 in the year she turns 67 would give her the upper hand. Sebastian, did you have any questions at this stage, or you're quite okay with the way things are going?
No, all good. I just would suggest that we might start diving a bit more into the SMSF content that we're going to focus on tonight.
Definitely.
I think it's a great little intro into super, and obviously just to recap some of those important rules around pensions and contributions for our clients. So yeah, without further ado, I'll get you to maybe get into that.
Certainly, because we're getting into estate planning, and what I just want to speak to briefly is some people have an individuals as trustees of their SMSF rather than a company. So my strong recommendation is, after many years of experience, is always to have a corporate trustee. And I've set out a link on this slide of the compelling reasons why to have a corporate trustee. In this climate, especially with the risks of bankruptcy and insolvency and receiverships being at a higher level with COVID, it's ever more important to have a corporate trustee. Indeed, some people might have their corporate trustee, which also runs the business. And I would encourage those that have the corporate trustee, which has more than one hat on, such as running a business and being the trustee of the super fund, it may be a good time to think of having a separate corporate trustee purely to operate the super fund. And that would be particularly relevant to companies that might have some risk. Like, let's say someone's running a building activity or a professional enterprise, such as being a medico, or so running a hospitality function centre or restaurant. In that event, there could be a real financial risk associated with running that business, or it could be legal risk to the medico, or it just could be lack of trade where you're struggling to pay the debts. And the point is, if you have a corporate trustee which is taken over by a liquidator, the control then cedes with that liquidator, and your assets that are linked to that company that belong to the super fund, you will have to prove and try to get them back to protect those assets from that bankruptcy or liquidation. So just a point, there's about 9 points there in that article, which, as I said, is sound reason to have a corporate trustee. Individual trustees is just not a good idea. The penalty regime, if you have two trustees, a penalty of a lot of the penalties under our admin penalty systems is no fault penalties, is $13,200 per event. And if you have two individual trustees, like typically mum and dad, your starting penalty is double that amount, being $26,400. So they just multiply the penalty per individual trustee, whereas with a company, it's just a one layer of penalty being $13,200. Now, I'm just mentioning that because if I got a parking ticket for about $80, I would not be happy for a long time, but these penalties are real money. Now, moving on to estate planning, I just want to cover briefly binding death benefit nominations, which I'll refer to as a BDBN. The starting point is a BDBN is not compulsory, but they can be very useful. And in fact, these days, they are becoming more popular. I'm just going to give you some wording, some suggested wording, because Joshua came along, and let's say Joshua is my client or Sebastian's client. And Joshua has it in mind that his super upon his death is to be paid to his spouse, Rita. But if Rita doesn't survive Josh, he would like his benefit to be paid to his estate. So when you are looking at your BDBN, you often are provided with a form, but in some BDBNs, you write them similar way to a will. And some suggested wording for the key wording in the BDBN that to achieve Joshua's goal would be to say, my trustee must pay my benefit to Rita, provided that if Rita predeceases me, my benefit must be paid to my legal personal representative. Now that term legal personal representative, or LPR, is a technical term. It's used under the superannuation legislation. Now, I'll just give you a little bit of a war story. We have this lawyer who was based in Queensland. He was a retired lawyer. He went to his accountant, and his accountant had prepared the BDBN. The BDBN had the words, as noted here. It didn't have the words legal personal representative. Indeed, the actual BDBN form said if you want your super to be paid to your estate, make sure you use the words legal personal representative. But Mr. Munro, via his accountant, had the words to the trustee of deceased estate. So the interesting point here was this went to court, to the Supreme Court of Queensland, to determine whether trustee of deceased estate was sufficient for the BDBN to be valid. And the Supreme Court held that it wasn't valid. It was not valid because it did not follow the requirements in the deed. The deed said to be a BDBN, it must be to a dependent, and a dependent is a spouse or child. There are some other dependents, such as a financial dependent or an interdependent. But in this case, the BDBN failed because it didn't have the requisite wording, being legal personal representative. It had trustee of deceased estate. And you and I would generally think that the trustee of my deceased estate is the estate. But there's about 6 arguments put forward that failed why the words trustee of deceased estate did not satisfy the provision in the deed. So unfortunately, Mr. Munro failed, and guess what? Mr. Munro did not want to pay his accountant to prepare that BDBN either. Not surprising, retired lawyer who wanted it on the side, on the cheap, maybe. Moving on, here's the example where Josh has 2 children from a prior relationship. So Josh here wants to favour Rita with his super, but he thinks if Rita doesn't survive, I want my 2 children to benefit. And as we know, second and subsequent spouses are becoming more common, blended families. So in this example, the suggested wording could be, my trustee must pay my super to my spouse, Rita, provided that if Rita predeceases me, my super benefit must be paid to such of my children, Oscar and Emma Bird, that survive me, and if more than one, as tenants in common and equal shares. So in this event, we're trying to get a cascade. We're trying to say, yes, first base, we favour Rita. But if there's no Rita, we want it to go to children of prior relationship. Having said that, the question will be, who is controlling the fund after Joshua goes? Because typically the person controlling the fund becomes very important. And Sebastian mentioned that just before, this point about the corporate trustee. It is very wise to know who has access to the shares, who can vote in a director. And in the case of a corporate trustee where the mum and dad have a 50-50 shareholding, it could be that if dad has children from a prior relationship, he would want his children to be attorneys under his power of attorney that could vote his shares if he loses capacity or if he dies. But the problem here is, even if Oscar and Emma could vote for dad, being Joshua, it's only a 50% vote. And on a 50% vote, Joshua could not have one or two of his children to step into his shoes to protect his payment of his death benefit in that instance. So there are other strategies here, and Sebastian before mentioned that word, successor director. So in a constitution, you could have a successor director. You would need a special constitution to achieve that end, but it does give you that extra element of control. Look, I also just wanted to note here, don't be too creative with BDBNs. We generally try to keep them simple. Indeed, with the BDBN that comes with our SMSF deed, we have a very good pro forma BDBN form for you to complete. And for most of our clients, that's just does the job very well. But be careful if you've got these cascades, because in this event, if, for instance, Joshua's super was aimed for Rita, but Rita predeceased, and then it was no Rita to go to Oscar or Emma, in the event that, say, Emma predeceased as well, then you could not have a benefit go out to the children of Emma. So therefore, one other option is to have a more simple process, and that is, if my super goes to Rita and there's no Rita, in that event, I could then pay my super to my estate by the proper words, as in the legal personal representative. And under your will, the legislation in each state and territory would pick up in a will where a child predeceases, leaving children of their own. So under a will, grandchildren would not miss out. Under a BDBN, grandchildren can miss out because we don't have the legislative provisions under the Wills Act for BDBNs. Now, I just wanted to give one further example on a BDBN, just to bring out another example. This is more advanced. This is Joshua. He wants his spouse to get the pension, but if there's no spouse, he wants his children from the former relationship to get his super. In this event, the BDBN would have words along the lines, and I'm just making this more general wording for now. My trustee must pay my super to Rita by way of an account-based pension. And that account-based pension must be an automatically reversionary pension to Rita. However, if Rita predeceases me, I want my benefit to be paid to such of my children, Oscar and Emma, that survive me, and if more than one, as tenants in common in equal shares. Now, I actually made a bit of a slip up when I mentioned that, because I said if Rita predeceases, I want my benefit. It really should be mandatory language. It should be, if Rita predeceases me, my benefit must be paid. And I just emphasize that word must, because there's one legal case called Donovan, Queensland Supreme Court judgment, where they used the word I wish, and I wish had no mandatory language about it, and therefore the BDBN failed. So just a few points here. Make sure if you do want to direct the type of benefit, in this case, Joshua wanted his super benefit to go to his surviving spouse as a pension, which is an account-based pension, being automatically reversionary. You should have express power in the deed to achieve that, because a lot of SMSF deeds only allow to who, but not how to pay. So again, you should just have express wording in your documents for that. There is an article that I refer to at the bottom of that page, which is very good reading, just to give you some more information behind where I'm coming from there. And in the DBA Lawyers SMSF deed, we do have that power. And in the BDBN that we provide, we also have the ability for the BDBN to make pensions automatically reversionary to a surviving spouse. There's a bit of an art to making a pension automatically reversionary. You need express provisions in your deed, and not all deeds have that power. On this slide here, on slide 14, I'm just mentioning a couple of judgments. It's amazing how many judgments there have been in Queensland. There's one WA judgment here, but Munro's case, there's Cantor Management and Booth, there's Ray Naramon. All of these cases, and also Hill and Zuda, they all confirm that the BDBN is really a creature of the deed, rather than having to rely upon the superannuation legislative provisions, particularly the Superannuation Industry Supervision Regulation, Reg 6.17A of those regulations. So 6.17A prescribes the criteria for a BDBN for large funds, but for small funds, that legislative schema does not necessarily apply to an SMSF if the deed excludes it. Indeed, in Munro's case, the deed required the express wording legal personal representative, and failing to comply with the deed was a failure to that BDBN. Just be aware that many deeds do invoke the SIS BDBN provisions, and that is not a sound way to go, because it is giving rise to greater uncertainty. It's best that the deed is very sound, particularly if you want a BDBN that is binding and one that can last for more than 3 years. Under the SIS provisions, a BDBN expires every 3 years, and a lot of clients come to me and say, Dan, can you review my BDBN? I say, you don't have one. They say, what are you talking about? I said, well, this is over 3 years old, and therefore it has expired, and therefore you have no BDBN. And it's surprising how quickly 3 years does come up in practice. Here's another reference to an article on our website. It's a very useful article about BDBNs. It goes into a lot more detail than I have covered here. It gives quite a range of other cases on point where you can get some really great war stories too. One of the classic war stories is where mum and dad were individual trustees. Mum died first and dad survived. And dad, having been an individual trustee, didn't decide to get a corporate trustee. So dad looked at his children and said, who shall I get as a co-trustee? Will I get my son Daniel, or will I get my daughter Linda? So dad looked at them and said, I'll bring Linda on board as my co-trustee, because you need at least 2 trustees as individuals. Then when dad passed away, who did Linda get on board as the co-trustee? Did Linda look to her brother Daniel and say, Daniel, come on board? There's $1.2 million we now have to pay out of dad's death benefit. And dad actually asked us kids to share it equally. So dad's wish, being a non-binding wish, it wasn't a binding death benefit nomination, was you kids share my super equally. And Linda, at the first opportunity after the death of her father, appointed her husband Martin as the trustee. And guess what happened thereafter? She paid herself the full $1.2 million. Daniel was left out in the cold. he took a legal action to the Supreme Court, lost, the discretion was validly exercised, and all he got was some compensation for his legal costs, which could have been hundreds of thousands of dollars. And Daniel and Linda thereafter never spoke with each other and were not good friends, from what I'm led to believe. So BDBNs are important, and BDBNs are increasingly important, particularly where you want to entrust your surviving spouse with the decision on your death to be both executor and the surviving trustee or the surviving director of that fund. In that event, where the surviving spouse is controlling the fund and is also the executor, as the executor, the surviving spouse has a duty at law to bring in the money for the estate. And therefore, if the surviving spouse as the executor and also as the trustee or controlling the trustee pays themselves directly, in that event, by paying themselves directly, they have a severe conflict. And having that conflict, that could be challenged. So in order to overcome the potential conflict, the best solution there is to have a BDBN which takes out the discretion. In that event, if the BDBN is to pay surviving spouse, the surviving spouse who is the director must pay that money across. There's no discretion, therefore there is no conflict. So be very mindful of that where you have a surviving spouse who you want as your executor and also in charge of the fund, and noting that they have a conflict and how do you overcome that conflict. Similarly, that issue arises with an enduring power of attorney, where these days we need express wording to overcome that potential conflict. Now, I just wanted to cover testamentary trusts. And testamentary trusts are wills that are more advanced wills, more than the simple mum and dad will. The simple mum and dad will is if dad goes first, everything to mum. Then after mum goes, it goes to the children. With the simple wills, there's no flexibility, there's no asset protection, there's no tax efficiency. So with a testamentary trust, we can have flexibility because we today, we don't have to say who gets what, we can leave it to the trustee. So if we trust those that we entrust, our executors who become the trustees of our testamentary trust, we then have some flexibility and we can guide them along on how to do the job. We also gain asset protection. And when you think about it in this environment, if you have a child or a relative that you're wanting to give money to and they're in business, and as a result of these harsh economic conditions that we have, they go into bankruptcy, then your wealth could be going to feed the creditors. And I'm sure that's the last thing that you want. Whereas if you leave money to the children and it's in trust for them, and they go into business and they go belly up, they go bankrupt, in that event, your wealth is still protected. Indeed, someone rang me, it was about a couple of weeks ago, to say, Dan, I've just got an inheritance and I'm bankrupt. What's the story? I said, sorry, that's all lost. That's all gone to your creditors. Had that person come to me in time to rewrite their parents' will, that would have been quite a different story. If we had have protected that, put it in a testamentary trust, we would have protected that inheritance from the creditors. As far as tax efficiency is concerned, we can get income splitting, we can get capital gains tax streaming, we can get advantages to children and grandchildren who are under 18 years of age, because in that event, we can use the full adult tax rate rather than under 18. They normally get taxed at the top personal tax rate of 45% plus the Medicare levy. So there are some great advantages to having a testamentary trust will. I've put some key points on this slide number 15. The choice of executors, trustees and appointors is very critical. The appointors hire and fire the trustees. Do you provide a separate testamentary trust for each child, or do you just provide one general testamentary trust? And that all depends as well on the risk of the divorce and separation risk of your children, or in future, your grandchildren. The family court can cut through trusts, and therefore the general trust on balance would be stronger through a family court battle. Indeed, most estate planning, a lot of parents are very concerned about the separation risk of their children. So the separation risk is often very top of mind when they're doing the estate planning. Naturally, you want to consider who the beneficiaries are. These days, it's quite important because with a trust, if you have a potential for a foreign beneficiary to benefit under your trust, including your estate, there could be extra stamp duty, there could be extra land tax. So take advice on that. If you do envisage that you are purchasing property in a trust, or you are incurring extra land tax because your trust doesn't have an exclusion for foreign beneficiaries, just take advice on that. Each state differs, so that the foreign duty and extra land tax surcharges, the legislation changes from state to state, and it's quite unique to each jurisdiction. So I mentioned the word conflict before. Just make sure you have express wording. As I said, if the surviving spouse is to be the executor and also the trustee of your family trust or trustee of your super fund, having express wording to overcome conflicts, if you do trust your surviving spouse, would be very wise these days. Sebastian, before I move on to the next topic, did you have any points to make on estate planning?
From my side, I'm definitely 100% wanting and focused for our clients to have estate planning, properly considered and carefully planned. You mentioned the area that point about successor directors around corporate trustees, and making sure that if our clients lose their mental capacity, that there is that plan in place to know what would happen next. Unfortunately, we do see so many scenarios where that planning wasn't considered far enough in advance, and now we're left with having to apply to tribunals to get guardianship and attorneys appointed post the event, which just provide extends that extra bit of stress and anxiety around what in the day was could have been quite a simple process. So that's probably the key takeaway here that I would like my clients and everyone to understand, is that it's never too late to get sound estate planning completed and to seek that help, but don't leave it for any unforeseen event happening that it is too late, that we can't actually do anything, like you mentioned there before, that clients have an opportunity now to check, consider, and put the right documents in place. So no, that's all I wanted to make sure that point was definitely honed in tonight for sure.
I think it's a very good point, and it's better to have a plan than get caught out. You never know the hour nor the minute. So it's wise for you to pull out yours or your clients or your family members and look at them. And even my children, my daughter recently turned 18, and I sent her off to a lawyer colleague to get a will. She's got a power of attorney. So I'm very, onto this, but I try to encourage my clients as well to have up-to-date documents and to pull it out at least every 3 years to review it, to make sure you got the will. As I said, a testamentary trust will is generally far better. When I have looked at my clients, most clients have a TT will, not the simple will. Simple will, no real efficiency or flexibility. On the odd occasion, there was a simple will could do the job, but making sure powers of attorney, successor directors, really, I'm a big fan of successor directors. It's in our constitution. There's some articles on successor directors on the DBA Lawyers website. They're a very good idea. Just having everything in line in the one spot, so that if anything happens, if that eventuality happens, you're right, you're covered. Moving on to limited recourse borrowing arrangements. self-managed super funds can borrow. They can borrow and even borrow from a related party. And indeed, we have been doing quite a lot of limited recourse borrowing arrangements of late. It's interesting because the major banks have largely pulled out of this space. And Sebastian, you and I were chatting the other day, and you said there's really three financiers at the moment. We don't need to mention their names, but they're not really major banks. They're non-bank institutions largely. And they provide finance, but the major banks really, they might lend to individuals or the entities of the individuals which on lend to the self-managed fund. So invariably the documents that we're doing for super funds that are borrowing, typically to acquire property, is the related party LRBA, limited recourse borrowing arrangement. I know there's a number of acronyms here, but I've got all the acronyms in the back in the dictionary at the back. But the limited recourse borrowing arrangement has been popular. You still have to be very mindful, because if it is a related party borrowing by the super fund, then the ATO has put out what we refer to as the safe harbour. The safe harbour is this PCG, Practical Compliance Guideline, 2016/5, and it provides certain criteria. You know, that is, your maximum loan period is 15 years for real estate, monthly principal and interest repayments. The minimum prescribed interest rate for this financial year is 5.1%. Seems a little bit high, but in respect of limited recourse borrowing, where the only asset used as security is the actual property, in that event, I understand it's a reasonably competitive benchmark interest rate, and you may be paying higher, like just over 7%, from these other institutions. Here's a more detailed summary of the Practical Compliance Guideline, the Safe Harbour. Here is the prescriptive requirements, not all the prescriptive requirements. Go to Google and just search for PCG 2016/5 ATO, and the more detail will come up. But as mentioned, 15 years. You can fix the interest rate for up to 5 years. You have a maximum loan to valuation ratio of 70%. You must have a registered mortgage for real estate, and it must be monthly repayments. So that's the guidance to stay within safe harbour. And it's still pretty effective for some people to have, if they have a family trust or they have a company, they can lend to their super fund, provided you comply with those requirements. You can have your friendly party lender, or if you're borrowing from a bank on security of your home, you then do a non-recourse loan from yourself or say your family trust over to your super fund to enable your super fund to leverage up its portfolio. And you can also leverage up listed shares and units. The safe harbour only extends to listed shares and units. So for instance, if you wanted to leverage up and borrow for, say, Vanguard unlisted units, and by the way, I do not give any investment advice, you still can, but you must have arm's length evidence of the borrowing criteria. Did you want to comment on that at all, Sebastian?
No, I think you covered it quite well there, Dan. I guess, yeah, we are seeing a lot more demand or query around, you know, generally in limited recourse borrowing arrangements, but more so this related party function of it. One primarily due to that you know, margin in the interest rate. So, you know, trying to protect that cash flow and obviously, you know, build someone's own wealth rather than obviously, you know, letting that money sort of, you know, leak out of the sort of family group. But yeah, it's a in this time where personally you can borrow at some, you know, quite low rates, and there is an inkling that the RBA might come out on Melbourne Cup Day with another cut. So, you know, let's see and hope, I guess. But and that difference between having to obviously, you know, borrow this money from that external lender compared to if you've got the capacity to look at it within your own scope, then yeah, there could be some great benefits there. So yeah, so we're just getting a few more inquiries about it from that point of view.
It is interesting because some people don't believe it's a good thing to borrow within super, but these rules do allow borrowing, and some people believe it is a very wise thing to do in super.
Yeah, I mean, I think it's just like everything. As we, carefully planned, properly, cash flow modeled, we put those, risk mitigating plans in place as well around insurance and the like, and that way there, there's more clarity and more confidence that the plan will fruit, when we need it to, and don't forget, I mean, the sole purpose test and everything that's around that as being, the reason why we are doing these things has to be considered as well. So it's just making sure that all those sort of things are aligned and carefully considered, and that way then there is that certainty around it and more clarity. Yeah.
And the other important thing to note is if you are purchasing a property in your fund and you do the borrowing, make sure before you do, you cannot sort of do a subdivision or change that property in a significant way. So just be careful if you're doing a borrowing for real estate, typically no subdivision, no development until you've paid off that borrowing.
There's a number of, exactly like you said before, the super rules are complex and they keep adding layers and layers. Just a quick mention that with related party loans, there is still that need to have the DBA trust structure. It's not that by doing a related party loan you avoid the DBA trust or the what we call the holding trust structure. That is still a given. It's not either or. It's either if it is related party or from a third party, the same structure needs to be in place. And just around that, Dan, actually, is there a bit of a process to that? Like what should be done first? Like if a client comes and does want to buy a property in a self-managed super fund, what should come first?
Look, there certainly is, and the answer to that is we've got it all mapped out in our documents because what jurisdiction it's in.
It can change.
Each jurisdiction changes. So what we have at the back of we've got a memo, and at the back of our memo, we've got each jurisdiction of this is what you do first. This is a name that the contract goes in. The deposit should always come out of the fund. There's all this strict protocol to get that right. If you don't do that properly, you could be up for extra duty and you could be even contravening some of the rules. The other thing I might note here is we are dealing with the current financiers. They're often putting in very prescriptive requirements for us in documents that we would never want to put in. And all the lenders are wanting to do is cover their necks and expose the client. And it's really shocking because that's why we prefer related party borrowings, because these lenders want all these prescriptive requirements. And we say to our clients, that's not good. That's only serving the bank's purpose and it's putting you at risk. But if they want the loan from that financial institution, the financial institutions don't budge. So we have seen some really bad provisions that these financiers have been putting in that are not required. They're overboard, and we're still writing to their lawyers and to the heads of these financial institutions because our documents we were the first provider in Australia of LRBA documents. We're the first law firm to get them out there. They came out in September 2007. We were the first law firm in Australia to have our package out there, and we've been on top of the market ever since doing LRBAs, which is it's really a shame that some of these recent lenders have been quite prescriptive. Moving on to investment strategies, which is probably a favourite topic of Sebastian's, but I'm covering it from a legal angle, and I might ask him to comment after the next slide on this topic. But the ATO has upped the ante. In early 2019, the ATO looked at self-managed funds and saying, broadly, you self-managed funds are not looking after your best interest. That is, the main thing that the trustees of a self-managed fund should do is invest their money to get the best yield or best return. And the super legislation, particularly section 52 capital B 2F, it requires a trustee to formulate, review regularly, and give effect to an investment strategy that has regard to these circumstances: the risk, the likely return, the objectives you seek to achieve. Is it a 5% return? Is it a CPI plus 1%? And cash flow requirements. The composition of your investments, what sort of class of investments you're getting to. Do you have enough diversification? Have you taken into account the risks? The liquidity, mentioned before, paying your pension. Can you pay your pension? Can you pay your benefits if someone is incapacitated or has temporary incapacity and just needs an income stream for that period? Can you, pay your liabilities as and when they come due? So these are the things that trustees should do, and the term review regularly is at least once a year. And indeed, I have a self-managed fund, and my auditor is at me every year. Where's your revised investment strategy, Dan? So I have to sit down, do that, sit down with my spouse, Margaret, cut a new investment strategy, look at our objectives. Where are we heading for the next 12 months? I don't actually mind that. It actually, because I keep track of my investments, and I've got a couple of properties, and I see the increase in value. I'll probably now have to being in Victoria, mark a bit of a decrease in value. In fact, I've got one property no one's paying rent on, so that's a pity, but that's what has happened as a result of COVID. In any event, in addition to that criteria that I mentioned, there's this other regulation that comes in, and this other regulation is you need to consider whether you have insurance. Now, what insurance do you have for your members? Do you need insurance? And these requirements are not mandatory. You have to consider them. But look, for instance, you might consider, I've considered insurance, but I don't want insurance. That's fine as long as you've considered it. But where is your evidence to prove that you have considered it? So when the auditor comes along or the ATO comes along and knocks, where is your evidence? Because the ATO have been asking to look at it, and auditors are not happy anymore with an investment strategy to say, oh, we invest in Australian equities, 0 to 100%. We invest in property, 0 to 100%. We invest in cash and fixed interest deposits, 0 to 100%. That now no longer washes. You need to be more accurate with that. You've got to say, look, with shares, I might invest, 20 to 30%. With property, I might invest 60%. With cash is the balance. Fine, but is that really what your composition is? So people are getting queried on this. Make sure you have your investment strategy reviewed. Preferably you get some professional input, someone who's good at investments. Did you want to make a comment on that, Sebastian?
No, obviously, I'm definitely hoping our clients are accustomed to receiving updated investment strategies. We do take this part of what we do for clients quite seriously because of the laws and the penalties that obviously underpin why you need an investment strategy. Just to add on to your point there, yeah, what we're looking to do basically is look at what is the current composition of the assets of the fund. Does that align to the members' risk profile and their objectives? And if it does, that's great. Then we'll obviously mark out a suitable benchmark or like you mentioned, the allocation of the different assets in the different asset classes. But if there's any variation, is that there's to be reasons why, and that needs to be documented. And if the investment strategy then needs to be altered, that it is altered with I guess a forward-looking eye on it. So it's not a historical-looking document. It is a forward-looking document, and it's all about assessing where the fund is right now. Does that still align to the members' objectives and their risk profile? And that going forward, that the trustees, I guess like you said, they've got a duty to the members, a best interest duty, to ensure that the fund is achieving those objectives and the investments are appropriate for the members.
Yeah, and I think, one of the problems with self-managed funds is well, it can be a problem, it can be an advantage at times, but often people are very hell-bent on getting the best tax outcome, like making the contribution
Mhm.
before year end. And
Yeah,
it's sitting there still in cash.
that's correct.
And today in cash, you're getting, what, less than 1%.
That's right. I think, yeah, for trustees, they're just going to be, aware that even though they probably do, obviously, in most cases, play both roles, member and trustee, they're probably not going to do anything that's going to be detrimental to themselves. But it is a detriment because there are alternatives, right? And as trustee, you've got to show that you actually are thinking about these things and documenting them correctly, in a format that the ATO obviously would recognise as being adequate. So.
And the people that are keeping them honest is the auditor. The auditor is now onto you. Where is
And
that
yeah, they've
investment?
got their own battles at the moment, obviously, with the ATO as well.
They certainly have. The other thing that sort of flows from this is your valuation. There is this regulation that requires the super funds financial statements to reflect the market value of assets. Now, that's generally no problem with shares and listed investments. Certain non-listed investments also have a up-to-date valuation method about them. But if they're private company shares or units in a private unit trust or real estate or other types of investments that are not mainstream, then the ATO is putting out warnings that even if you have real estate and you had a proper registered valuer, as a result of recent natural disasters, floods, bushfires, and COVID, prior valuations may not be valid, and you need to look at the valuations quite carefully to see whether they still reflect the proper valuations. In this case, we're more focused on 30 June 2020, the financial year that's just passed, because for your accounts for 30th June 2020, they should reflect market value. The ATO have said in this, I've got a reference to their website. There's a reference called QC, as in quick code. So if you do a search for ATO QC 26343, this is the latest information on valuations. Because the ATO say you should consider the use of a qualified independent valuer if either the value of the asset represents a significant proportion of the fund's value, or the nature of the asset indicates that the valuation is likely to be complex or difficult. So where it's a significant proportion, like it's 70, 80% of the fund, or where it is complex or difficult, like private company shares, and you really need a very experienced, say, accountant to go in to value that company, then that's where they would like to get independent evidence. And the valuation should be based on objective and supportable data using a fair and reasoned process. So therefore, it's appropriate for trustees to gather valuation evidence. It may be that you approach, in the case of real estate, a real estate agent, but generally that alone is not sufficient. You'd want to gather other evidence like recent sales, any activity in that area which is a comparable property. The internet has certain property sites that give you an appraisal of value on certain properties. So trustees could save some time and running around by their accountant and auditor by gathering the evidence, maybe doing a trustee resolution to say, look, my property or my assets as of 30 June 2020 were valued this value for these reasons. Here's the evidence. Sebastian, did you have any comment on that? I'm now on to virtually my last slide.
No. I think yeah, it did pop up recently. The ATO did provide a bit of guidance around this, and also we've communicated that to our clients. We do have a big cohort of our clients that have real property. Thus, valuations always pops up as being a question that's asked coming close to 30th of June. So I guess I just want to I think you clearly stated what the ATO is sort of looking for, what the auditors are going to be looking for. as part of their file notes to support that valuation of the balance sheet. So clients that have bought property in the past and just let it sit on the balance sheet at cost, definitely there's going to be some concern around that by the auditors, and if it's left unattended, then possibly the ATO as well. So we want our clients and trustees to be aware of their ongoing duties and obligations, just like everything else.
Thank you. Now, the last slide, I'm just going to pick out a very brief point on this slide. This slide here is not to scare you, but to be forewarned is to be forearmed. I mentioned earlier the admin penalties. Here's an admin penalty. It could be a loan to a member. It could be an in-house asset where you've invested more than 5% into a related entity or a related trust. So the penalties are quite severe, and indeed they are far worse if you do more aggressive things. But the admin penalties alone at $13,200 per pop. For instance, if you have borrowed some money from your fund, then that's $13,200. If you got a corporate trustee, $13,200. If you got two individual trustees, $26,400. But take this. Let's say you borrowed $10,000 from your fund, and then several weeks later you borrowed another $10,000 from your fund. And where I'm coming from here is during periods of tight financial times, like people not having a job, people accessing money from their fund, they might be doing it when they're not allowed. They might be only 40 and they're getting desperate for money, and they need to feed themselves and pay for the rego and pay for the mortgage and children education. You know where I'm going. Or it might be you're in business and you don't have enough money in your business, so you're raiding the till. You're going to the super fund. All I'm saying is be very careful. The ATO is not very sympathetic for those people that take advantage of the fund. And I suppose one of the downsides to a self-managed fund is this. Let's say someone was financially destitute and they put their hands in the fund and pull some money out. There's no one there really to hit them on the hand to say, get your dirty mittens out of that cookie jar. So they might go back, and they do it twice, and they do it 3 times. And look, I can tell you, I've seen clients come to me, business people, professionals, they haven't lodged their returns for 2 or 3 years. Their lifestyle has depended on raiding the till, pulling the money out of the self-managed fund. It's not a very nice story. And you need to go to the ATO and tell the ATO and just ask them to be very nice to you, but you can get hit very hard. A lady recently opened up the mail. $600,000 was the starting point of your penalty. I've had clients come in and they've been rendered non-complying. Starting point for me is to go and save them a couple of $1 million. Almost their entire life savings was going to be wiped out and their business because of the ATO bill. So you don't want to be in that basket. So just make sure you play by the rules, but sorry to finish on that sober note.
That's fine, Dan. I guess just to maybe lighten it up a little bit, there are obviously potential means to look at proper considered investments from your self-managed fund to a related entity. So the things that we call like in-house asset investments, I guess. Very strict guidance around those as well. So definitely not, it's definitely not for everyone. And it's only for those that are very careful and remain compliant around their obligations as well. So yes, the ATO has a big stick, but there is, enough in the laws to allow, legitimate investments to be made by your self-managed super fund to related entities. But that's the big word there, related entities, not related members. As Dan mentioned there, if you take money out and you put it straight into your own personal bank account, there's no way coming back from that. It's very difficult to then prove otherwise that you do not illegally withdraw money from your super fund.
Just on that point too, Sebastian, the government has allowed up to $10,000 to be released if you have got job seeker, or if you have got a drop in your working hours or
Correct.
your turnover. So if your working hours or turnover has reduced by 20% or more, you can get $10,000 out before 31st of December this year.
Correct, yeah.
There's also financial hardship, there's compassionate grounds, there's also temporary disability. So there are, as Sebastian said, there are some legitimate means of accessing some super money. There may also be up to 5% of the money could be used in a related entity, but again, be very careful, get advice before you do that, make sure you got the right documents in place. So really on my final slide is really remain compliant and play by the rules. Always seek advice before proceeding if there is any doubt. And now, Sebastian, it's really up to questions. If anyone has any questions.
I'm just going to quickly run through Q&A here in the chat. I think you've been quite thorough through the presentation to probably capture maybe what's on people's minds. I can't really see anything quite standing out. I mean, the question around the pension, why do I need to take a minimum pension amount? You cover that quite well. Around, it also can the pension would cease, and then the tax concessions around that strategy would also cease. Question around just a clarification question around bare trusts and related party type of loans. Just that that has to be in place. Like we mentioned, different jurisdictions have different processes and steps that should be considered. That's really about it. That's really about it tonight. So definitely, yeah. If there are any questions out there, please let us know. We're happy to answer them. Otherwise, if you have any questions after the event and after you receive copies of the notes, we're here to help. I don't think we have any more to add apart from that. So I might just tidy up some.
Something now coming up, Sebastian, by Stephen. There was a chat in the chat section.
I think that had to do with here we are.
Stephen's asked a good question. If you have two properties, do you need two bare trusts? Stephen, the answer to that is you do need two bare trust deeds, but you only need one custodian company. So the one custodian company could hold two properties, but you do need a separate bare trust for each property. You should also be very careful on the documents, the financing documents, because you don't want to have the security with one property being cross-mixed with the other property. So you don't want to have one property joining the other property and vice versa. The property should stand alone. The security by the lender should stand alone in respect of each property.
Just to add that, then, can you use the same corporate trustee?
Correct. So when you say corporate trustee, I'll use the word custodian because the custodian is the corporate trustee of the bare trust.
Okay, great. That's always a bit of a query by clients who are trying to obviously, save a bit of money on setting up these structures.
Well, exactly. And look, you could have 4 properties, 5 properties under that same custodian company.
Right. We've got some more questions actually come through. I think everyone's got their thinking caps on now, so that's good to hear. I've got a question here from Michael. For concessional contributions, what is the maximum I can contribute in one financial year if I haven't made any contributions in the last 5 years? Okay.
We can only go back as far as 1 July 2018. So we've got 19, we've got 25. FY20, we've got 25. We're now into 21, we've got 25. So we're up to 75.
75.
So the maximum would be 75, but just make sure you have checked that you didn't have any other concessional contributions, because that would come off the 75.
Of course. And that with claiming super contributions as a deduction, they're basically an offset to income, so they can't push you into a tax loss position.
Put it this way: if you are self-employed you can only write off your taxable income. As you say, Sebastian, you cannot create a tax loss. In respect of an employee, your salary is sacrificing the amount, so it doesn't come into your taxable income to start with.
That's correct. Okay. Okay, got a question here around some investment strategy stuff. So things around, can I sell my block of flats to my self-managed super fund? It's probably a number of different layers there, but
this is a very good question. And in fact, Sebastian, you put a similar question to me earlier today.
yeah, we did.
Okay. The starting principle is the super fund is prohibited from acquiring an asset from a member or a related party unless it is business real property. So the first point is the block of flats business real property? On its own, I would have to get far more background, but there are some examples in the ATO material where if the owners, being the members, were doing sufficient work to manage those flats and was quite an involved set of flats, and there were, say, 20 flats, and they relied upon that for the primary source of their income, and they're actively involved in managing those flats and getting tenants in and cleaning it up and maintaining it, there may be an argument. But otherwise, I would say starting point is no go. Get some advice. We often give advice in this area, and there's often, some cases are clear cut, you cannot do, others you can do, but some are arguable and in between. But you've got to be very careful, because the penalty here under section 66 of the Superannuation Industry Supervision Act is 12 months in jail. So it's 12 months in jail. We've never seen people do time, but it's either 12 months in jail or an equivalent monetary penalty, and it could result in non-compliance. So it is treated quite seriously.
Yeah. So yeah, exactly. So you just got to carefully consider the facts of the case, and that it aligns to what is business real property, and then look past that to say, well, would it actually be in your best interest to do that for whatever reason?
Or the other option might be it's an old block of flats. It really does need, like renovating entirely or ripping down and developing. In that event, there may be an argument on the right facts that we can mount that it would constitute business real property.
Yeah, fair enough. Exactly. It always comes down to the facts of the case, or 100%. Another question here. Can I put my kids in my fund? My super fund, even if they're not working?
That's a very good question. We've just put an article up on our website, so I would encourage your attendees to look at our website, www.DBA Lawyers. That's dbalawyers.com.au. We've just put up an article because the government has legislation in Parliament to increase the size of the self-managed fund to 6. Currently, the limit is 4. So you could have up to 4, that's mum and dad and 2 kids. But let's say you've got 3 children, you can't have your 3rd child in the fund. Under the new rule, you'd be able to have up to 4 children in the fund with mum and dad. But our position on it is this, there are pros and cons. The downside is, as I said, with doing wills and for thinking about children, is the risk of divorce and separation. The divorce rate alone in Australia is over 45%. And with young relationships, it could be quite risky. If mum and dad have their fund, they bring their child in, the child goes through a divorce. That super fund has to hand up all this information to the family court, generally be represented by a lawyer, and the child's interest in that fund needs to be assessed and valued. So it can be a real pain in the proverbial by having a child in if they go through the separation, because the whole shooting match of dealing with the family court system, even if they are a de facto. However, if you do what...
No, sorry, I was going to say, but there's no stopping the fund having minor children?
No, if they're minors, you can have them in, and mum and dad would act as their trustee or director. But when they turn 18, there is the potential for that child to become a director or a trustee. Now, having individual trustees is just not on, just get a corporate trustee. But even then, what the children can do is appoint their parents as attorneys. So therefore, you don't need your children to be trustees or directors. Indeed, look at the penalties that I put up before. Who would want their children's heads on the chopping block as well? Doesn't make sense. And generally, parents want to run the show anyway. Their kids don't show a lot of engagement, and they wouldn't be there but for their parents. I know that's not always the case, but these days with kids,
And that could be
until
on
they
exactly whether they're minors or independents.
Mm.
That role of attorney of that could be definitely put in place for sure.
So, and you've got to do that. Let's say you bring in a minor and they turn 18. You have 6 months in which to get them to be a director or a trustee,
Yeah.
or get a power of attorney for them.
Yeah, yeah,
And most of my clients want a power of attorney for their kids.
absolutely. Generally because they're the ones putting the contributions in the first place. Just another general question around who can be members of a self-managed fund. You don't have to be related. It can be unrelated. Exactly. It's open.
I had 4 people the other day. They're 4 friends. They're coming together. We want to buy this property. I said, not a good idea. Not a good idea to share a self-managed fund. They really are for you and your spouse and your children. To bring in others, it does have downstream consequences, but they were going to go off a one-off purchase, 4 of them. It was only a small purchase, but they had, big numbers on, what they would make out of this small purchase. It was 200,000 or 300,000, but they were going to flip it for about 600 in 24 months, according to them.
Yeah, yeah.
But they were coming together and they said, we'd do this, we'd flip it, and that's it. They're out of it. They'd then do their separate funds. But I suggested they do their separate funds up front and do a sort of a unit trust underneath to hold the property.
Yeah, that's right. We've had similar conversations with clients as well. It seems like a great idea, especially business partners. They see eye to eye on a lot of other matters, and they just feel that this is something else that they could, throw into the pot. But it can be a bit more messier down the line. Yeah.
We have a couple of assignments now where we're pulling apart the business partners that have been together for a long time, but it's not suitable. It's not working with their succession. They're going their different ways. Fortunately, at the moment, these people are getting on. We're having amicable discussions. Apart from one, it's pretty brittle, but we're still working through. But it takes a lot of work to work through. Who's paying the stamp duty on this property? Where are the costs going to be borne? Who's wearing the capital gains tax when we dispose of an asset, and so on.
Another sort of case that come past our desk not long ago is that it was a bit of a mixed fund, I guess, and one of the members decided to put in quite a large contribution that financial year. The asset was then valued or put on market to be sold, and at a considerably higher realizable value. It sort of stood that because he had a higher member benefit proportion, that he would maybe gain the most out of the sale of the asset. So these are the things that need to be, carefully, considered before someone makes, a decision, I guess.
Sebastian, it's been a wonderful night, and I think we've covered quite a few questions and points. And
I definitely appreciate. I'm just going to put up my last slide there, just to where is it now? Here. Just to obviously thank you, Daniel, for your time tonight. It's been greatly appreciated. Thank you to our guests for tuning in and for your questions. It's always, we're here for you. That's why we do these things. Thank you, Daniel, again. Thank you, everybody, for tuning in, and we'll look forward to seeing everyone soon.
Thank you, Sebastian, and thank you all the guests. It's been a pleasure.